In this particular video, we're going to look at a little bit more of a deeper look, if you will, into how these choices, how the choices of debt ultimately can affect the value of a company. So let's start with the decision itself. Essentially, the capital structure is that part of the right-hand side of the balance sheet that is long-term. The total capital is debt capital plus equity capital. So this decision is one of the most complex areas, and it's also one of the most important areas for us to understand how managers make decisions. A poor capital structure decision could increase the cost of capital, causing us to have higher expenses of financing that ultimately can reduce the net present value of all of our future projects and the current value of the company, and ultimately making those decisions and our past decisions be more unacceptable or at least not as valuable as what they used to be. But if we can make good decisions, we can find a cost of capital that we can live with, that is a relatively, in quotes, good number. That will help us projects, the best net present value projects, and also ultimately then increasing the value of the firm. So what does capital structure look like across the world, right? The same kind of industry patterns of capital structure are found all over the world. So industry that you're in, or the industry that you're in, can have an impact on the kind of financing that you do. The capital structure of the largest US-based multinational companies, can they have access to capital markets all over the world, right? They typically resemble the capital structures of those multinational companies in other countries. So finally, I guess the gist of this is capital structure choices are similar, right? Similar companies with similar risk, with similar markets will have similar types of capital structure. So the research tells us that there is an optimal capital structure. There is a capital structure that will create a maximum value for the company. The challenge is it's not possible to provide a precise methodology, right? There's no real formula that we can use to figure out what that capital structure is. Nevertheless, right, financial theory is going to help us understand how this decision, how this capital structure decision affects the firm's value. So in the late 50s, early 60s, Modigliani and Miller started asking some very basic questions about the finance world. One of the questions they asked was the question on debt. What happens to the value of a company if the company changes the amount of debt that they have? So since then, there have been lots of theory, lots of research done to address this basic issue. Now, Modigliani and Miller originally, in their theory, basically came to the conclusion that in perfect capital markets, a company's choice of financing has no effect on its value. Now, since then, we have lightened up some of the restrictions from that early research. We've talked a little bit about how taxes could have an impact. We've talked a little bit about the actual costs of debt based on corporations, based on other types of companies. We've also talked ultimately about bankruptcy and financial distress. So all of these tax questions and questions about financing and bankruptcy all have an impact on value that adds to Modigliani and Miller's original type of theory on value. So let's think about the tax benefit itself. if you're allowed to deduct interest payments, essentially what that does is it provides a bit of a subsidy, if you will, that the government is going to help pay for some of that interest because the interest expense is going to reduce profitability that in essence reduces taxes. So if we wanted to find the actual after-tax cost of debt, R sub I here is the before-tax cost times 1 minus T. So the actual cost of debt is much lower than we might think. So if you have a 10% coupon and you have a 30% tax bracket, you're going to be able to write off 30% of the 10%. So you'll be able to write off 3%, which means the debt itself only costs you 7%. So the tax benefit is something that you gain if you can deduct interest. The probability of bankruptcy is another component. If you kind of think about the tax concept, being able to deduct taxes is a benefit. But the more you borrow, the greater the probability will be that the company could default on its debt. Right? So the idea here is that the financial leverage of the company, as it increases, the chances of bankruptcy increase, which means in the end, there could be costs imposed on the company when they ultimately run into these financial distress issues. So the probability of bankruptcy just refers to this chance that on the outside, the company may have to default on its debt. And that's really what bankruptcy is. It's the penalty for not meeting its financial obligations. So the more fixed cost financing, the greater the chance of financial leverage and risk. The total risk of the company then combines the business risk and financial risk, and this ultimately determines this probability of bankruptcy. So if we think about these two things, as you borrow money, if you can deduct interest, that is a benefit. As you borrow more and more money, the company will have a greater probability of future bankruptcy. Having that future opportunity of bankruptcy is a negative thing. So as debt increases, both positive and negative things happen that ultimately net together to figure out what happens to value. And there is a point where the probability of bankruptcy and the costs of potential bankruptcy exceed the benefits that you get from the tax deduction of interest. When that point occurs, we are achieving or finding a we're finding an optimal point of financing. So we're going to look at a spreadsheet. It's called the EBIT earnings percent worksheet. And essentially, we're going to look at what happens as a company changes its debt opportunities. That is, what happens to profits, what happens to value as a company chooses different capital structures. So the first thing we really want to look at is what is the potential operating profit of the company. So there's a 25% chance that in a worst case scenario, EBIT will be zero. There's a 50% chance of $100 and 25% of $200. And the variable cost of the company is 50%. So if you see here, it's what? The fixed cost we're told was $200, $200,000. Variable cost of 50%. So if you, again, plug this out, that's how we ultimately get this profitability across the board here. So now what we have, now that we understand what the profit potential is of operations, now we have to ask questions about what happens with different types of financing. How does that ultimately affect the bottom line? So this company's current structure has no debt. It has $500 of common stock which means then the book value of their stock is $20. Again, they have a 40% tax bracket. If we look at their capital structure, how does that change? Well, on the left-hand side here, we have different debt ratios, from no debt to 60% debt. Assets aren't going to change, but certainly then the amount of debt we have changes relative to equity. And for equity, when you divide it by the price of stock, right, $500,000 of equity divided by $20 per share means we have 25 shares. But with $200,000 worth of equity and $20 price stock, that puts us at a $10 or 10 shares. What is the situation for debt? Again, these are all things that we're given that we know before we even make the decision, right? If you go to the bank and say, well, what's the interest rate going to be at different levels of debt? So if I have $100,000 of debt, the bank tells me it's going to be 5.5%. If they say it's $300,000, they're going to charge me 7.5%. So interest expense changes as we change the capital structure of the company. So let's look at ultimately the outcome, right? We know what EBIT is, we've calculated that, but now we want to, if the company has 0% debt, how does that affect earnings per share? So the interest, again, in this case, since we know it's 0% debt, there's no interest across the board. Taxes are 40%. So there's net profit after taxes. And the earnings per share of the company with 25 shares at, again, this capital structure, just tells us that it's going to be either 0 or $2.40 or $4.80. Here's our probabilities. The statistics here is actually what we want to look at. The expected earnings per share with 0 debt is $2.40. That's the average. Standard deviation 1.7, and the coefficient of variation is 0.71. What happens if we go to 60%, go to the other end of the continuum? Again, at 60% debt, we know here's our interest expense. We know that there's going to be taxes at 40%. This is a negative tax, right? We'll actually be able to write off negative numbers, right? So the net profit after taxes, negative $13.50 to $106.50. So the average expected earnings per share is $4.65, and standard deviation is $4.24. Coefficient of variation 0.91. So if we would have done all of these debt ratios, 0, 10, 20, 30, etc., we would have seen that there was a steady increase in earnings per share, steady increase in standard deviation, and the coefficient of variation indeed also increases. So here is the table of this, right? Here's the table of expected earnings per share. You can see that it rises. We see standard deviation rises, and likewise we also have this increase in the coefficient of variation. So what does that tell us about our financial structure? If you look, we have a maximum amount of profit. The maximum amount of profit occurs roughly at 50%. That's earnings per share will be the greatest. We also know that as we have increasing debt ratios, we also have this increasing coefficient of variation. At 0 debt, the coefficient of variation is 0. So this level, at 0 debt, whatever that coefficient of variation is, right here I guess it was close to 0.7, that is the amount of business risk in the company. As the coefficient of variation increases, the reason it is increasing is not because the business is becoming more risky, but that the company is taking on more financial risk. So again, this piece just illustrates what happens to profits, what happens to risk as we change the debt structure of the company. In the last video, we'll try to pull all of these theories and these thoughts together to try to understand the ultimate impact. What does increasing debt or decreasing debt, what does that have to do with the value of the company?